Welcome back to EDS, and in this video we're going to take a look at how you can write your own options contracts, generate a consistent return year on year, and collect a premium upfront. So the first thing you want to do is open up your brokerage platform. I use Tasty Trade. We're going to be using options as our vehicle to actually make the returns. Specifically, we're going to be selling options contracts or writing the contracts. So what we want to do is we want to see where we are in the options cycle. So we just want to pull up any underlying options chain. And we can see here, this is now our options chain. These are all our strikes. We've got our weekly expirations. We've got our monthly expirations. We want to stay away from the weeklies for the purpose of this video. We just want to stick with the monthlies. Obviously, September 20th is the next monthly expiration. That's far too close. We're going to go with October 18th, which is 31 days away. So now we know 31 days is how long we're going to have on these contracts, to start with at least. Then we can come over here to our watch list. You can just pull up any watch list and filter out everything that has earnings over the next 31 days, right? So what we'll be left with is a list of things that does not have earnings whilst we're going to be in the contract over the next 31 days. Then we need to come over to our portfolio, see what positions we already have on. We want to make sure that any positions that we are putting on is going to be a nice addition to our portfolio. You want to make sure everything complements each other. You don't want to be too heavy in any one sector or industry. We are slightly heavy on, AMD, SMH, Intel right now. We did have more positions on. We took some off. It's a moving. Your portfolio is a moving, living, breathing thing, right? So you want to always make sure you're keeping an eye on it and not feeding it too much of certain things, and make sure it's has a balanced diet of lots of different underlyings. So once you've got your watch list up, nothing here has earnings over the next 31 days. You know what you need to stay away from based on what's in your portfolio or what you need to gravitate towards. Now you want to have everything from high IV rank to low IV rank. We want to sell volatility, sell it when it's high, and then play the contraction. And at this point, all we do is we simply just go down the list, and we want to be keeping an eye on what the tickers are, what the liquidity levels are, what the price of the underlying is. Typically, the smaller the underlying, the less buying power will be required for naked positions. So we just want to have a look at our watch list. We want to stick with anything above 50. Anything above 30 is okay. Anything above 50 is really nice. Just to make the point, I think we can have a look at McDonald's today. It's trading at just under $300. If we look at our portfolio, we did have a position in CMG. However, we don't anymore. Okay, so we pull up McDonald's, and as we can see here, we're currently trading at about $295. We are sort of at recent highs. We have had a recent low here. Seems to be in this kind of range. IV has dropped off a little bit, as we can see here with this little rally that has killed IV a little bit. However, IV still isn't low by any means, and we could definitely still be looking to put a position on. This might be a nice time to put on a call credit spread, for example, if you only wanted to play one side of the trade. But what we're going to do is we're going to have a look at playing both sides of the trade. So we go over to the trade tab with McDonald's. We can see here it has earnings on November 4th, which is fine. Hopefully we're going to be out of this contract long before then. Now what we want to do is we want to make sure that the spreads are nice and tight. So as we can see here, it's 20 cents wide. It's 20, 30 cents wide, 30 cents. So it's about 20, 30 cents wide. It's not the tightest spread. However, it's not the absolute worst either. So we are going to continue. McDonald's isn't too bad at the moment. So what we want to do is we want to have a look at our delta column, and we want to be somewhere between 16 and 20 deltas, right, on both the call and put side. So as we can see here, we've got an 18 delta. strike. So we'll go with 18 delta, the 18 delta, which is a 310 strike, and we'll go with that on the call side. And then on the put side, we'll go with the 17 delta, which is the 280 strike. So we've created a range here, 280 and 310, right? Now, what does this mean? So this orange bar here shows you the expected move of McDonald's over the next 31 days. And as we can see, we've selected to sell contracts at strikes that are outside of the expected move. This means that we'll have a high probability of being correct on this trade. Now, that can be seen and confirmed by looking at our probability of profit calculated by our broker in the bottom left corner. At expiration in 31 days' time, there's a 71% chance of McDonald's being within the 280 and 310 range. And there's an 87% chance of hitting 50% profit on this position at some point between now and the next month. So these are very, very high probability trades. We're looking at between 70 and 90%. Okay. So what do the numbers look like on this position? So we'd collect $2.96 up front times 100 because there's 100 shares per contract. So that's basically $300 up front, and it would require $8,500 in buying power to maintain this position. So if we were to, and don't worry, I know that might look scary, we're going to go over how you can do this with a small account as well. So if you just plot this on the graph, 280 and 310, what does that actually look like? 280 is about there, and 310 is about there. So that's the range that we'd be working within over the next 30 days. Now, if price expires within this range, then we will keep all of the premium that we collect, all $300, right? And that's how we make money on this position. So now for the people who have a smaller account who might not want to allocate, best part of 9 grand to any one position, by all means, what you can do is simply buy a contract a little bit further out from the one that you sold. So if we look on the call side, we've sold the 310. If we go one strike down further out and we just buy the 315, right? What this has now done is it's limited our loss. So we can only lose money between 310 and 315. And then above 315, we're covered. It counteracts each other. So we're going to do the same thing on the put side, right? So we're going to go one strike down, again, same $5 wide, and buy the 275. Now, what this has done is it's massively reduced our buying power requirement because we no longer have an unlimited loss potential. We've capped our loss by buying these long contracts at 315 at 275. We collect less premium in the process. However, we have a much higher return on capital. So the broker's only going to require $378 from us, and we collect 124 up front. That's a much higher return on capital trade than what we were looking at before. Before it's $300 to 9 grand of buying power. So that's one benefit of doing it this way. However, the trade-off to that is we have a slightly lower probability of profit. Lower by about 5 to 10%. That will vary per trade, but that's the trade-off. We have a lower probability of profit, but we have a higher return on capital. There are more nuances than that as well, of course. However, for the sake of this video, that's the main thing that you want to keep in mind. So whether you've got a big account or a small account, doesn't matter. This is how you find positions. This is how you can put positions on. If you did believe for whatever reason that we were just going to go straight down, you don't have to place the put side, for example. You can just place the call side, get rid of the put side, and there you go. You'll collect half as much premium. However, your probability of profit just skyrockets upwards because you only got a risk on one side. So by all means, you can manipulate these positions and do whatever you feel needs to be done. So that's an example of how you can find a position on McDonald's. If we go over to our portfolio, there is one thing I wanted to point out to you. It is UAL. So with UAL, we did make some adjustments. We actually have been rolling UAL. We've been rolling the put side all the way up until it's now become a strangle. So our break-even point on this position would be $52.85, which would put us at just over here, $52.85. Price is currently at 53.63. So we will probably be looking to make another adjustment, and perhaps actually invert this strangle, turn this straddle into an inverted strangle. So this is what the reality of managing positions looks like. Not all the time everything just goes perfectly smooth, and you end up with a nice, clean P&L, and you can just you can just take profit nice and easily. That does happen most of the time. However, these are the times where we have to earn our money, and we have to fight our way out of these positions. So we're going to be looking at making an adjustment on this. Probably we're going to invert it, and yeah, we'll keep you updated on that one. So another thing that you want to keep in mind when it comes to positions is your position sizing, of course. So if you click the link in the description, you can click on this free position sizing template, and you can get this template completely free of charge. The way it works is you enter in your portfolio size. So let's say if it's $5,000, you then enter in the current VIX level. Let's say if it's at 16.3. Everything below will then be calculated for you automatically. All you need to do is use it as the backbone of your portfolio. Um, it will tell you how much to allocate to each undefined position, each defined risk position, how much to allocate to short risk premium in general in your overall portfolio. And as long as you stick with the guidelines in this template, you'll be just fine long term. So you can get that for free by clicking this button. Also, if you want to follow along and see what positions we have got on, and how we're making money and what we're doing on a daily basis, and if you want to copy our positions, by all means, again, link in the description. Click on EDS Premium this time, and get yourself signed up. It'll give you access to all of our positions in all of our portfolios, small and large portfolios. You get access to a full course, so no prior knowledge is required. We'll teach you everything you need to know. It is a private community, so you can speak with myself and other like-minded individuals. There's also a 100% money back guarantee. So if you've gone through everything and followed our trades for 6 months and haven't seen results, then we'll work with you for free until you do, or you can request a full refund. So it's completely risk-free on your part, and right now it's £1 a month. The price will be increasing. However, once you're in, future price increases will not affect you, so you're rewarded for getting in early. With that being said, I'll see you guys on the inside.